Hi everyone, so we're going to be covering FAO concepts that come up in exam questions, and we're going to understand what FAO is all about. Now it seems like there's a mountain to climb, and that the summit is far away. See what I did there? But with support from our tutors, your tutors, and hopefully from these videos, we can climb that mountain and get to the top. So passing is not far away. So we have to know what FAR is all about, and FAR stands for Financial Accounting and Reporting. Accounting for me means what adjustments do I need to post, what are the debits and credits, and how do I measure the 5 elements? Do I measure them using fair value? Do I measure them using stage of completion? Do I measure them using cost? Okay. So that's what the accounting is all about. It's about the numerical side. Reporting is more about what disclosure in the financial statements do I need to make? Do I need to put anything in the notes of the financial statements to give more further details to the users? Okay. Reporting is also, you could say, about what needs to be in the balance sheet, what needs to be in the P&L, what should be the format of the P&L or the balance sheet be. Should an asset be a non-current asset or a current asset? So think about both when you're answering questions. It's not just about the figures, and that's the difference between FAR and accounting, the accounting module in the exam, the accounting module in certificate level. But FAR, I mean, is all governed by the International Financial Reporting Standard, International Accounting Standards. So we're relying on those to know what to do. We're not doing our own creative accounting. And FAR is very prescriptive. You know, there are right and wrong answers. So there's limited uncertainty. In an exam question though, like if the exam question is 20 marks, there could be 30 marks that you can get potentially. The maximum number of marks you can get is 20. So there are lots of points to put in. But again, as I'm saying, we're following the accounting standards, okay? So there's a right and wrong answer. There are right and wrong answers. Now, the way I think about financial reporting and accounting is in order to be able to explain the accounting treatment, we need to understand the following. We have to understand what criteria do we need to recognize a particular item in the first place. And to record something in the first place, we call the initial recognition point. Recognize is another word for saying record. We then have to consider how do we measure the relevant item, say if it's an asset, how do we measure it subsequently? Can we still keep using the same method, or do you have to keep using a different method? For example, for intangible assets, you record them initially at the cost that you acquired them for, but then you can measure them at fair value if there's an active market, right? So we have to consider what the subsequent measurement for that relevant item is, and where does it impact the statement of profit and loss, and where does it impact the statement of financial position. We then have to consider what point do we stop recording the item. So if we sell an asset, we stop recording the asset. If we repay a liability, we stop recording the liability. And another word for stopping to record something is derecognize. So you have to understand these 3 stages. Now I'm going to cover 3 topics today. Borrowing costs, held for sale assets, and discontinued operations. I picked these 3 because you don't need that much knowledge to understand them, and they often come up, and you can get marks quite easily if you understand the criteria. And borrowing costs, I don't know why, they just love it, and it always comes up in some way. But I could be wrong, it might not come up this time. So borrowing costs is governed by IAS 23, and to introduce it, I have a picture of the Olympic Stadium. And the Olympic Stadium took about 3 to 4 years to build, and it was probably financed using loans, and those loans accumulated interest. Okay, so how do we account for the loan and the interest? Well, let's consider the principal amount on the loan. So the principal amount on the loan was used to build the PPE. So we would have done debit PPE and credit the liability with the principal amount. Okay, and that makes sense because to make an asset, to actually make the asset, we're using a liability. and it fits the equation where assets is equal to liabilities plus equity. So we're funding the PPE construction using a liability, so it makes sense from a double entry perspective. Now, how do we account for the interest? Well, let's see. You'd normally think, okay, I've got interest on the loan, that goes to finance costs. That's a finance cost. That's going to reduce my profit and loss. We're going to debit finance costs and credit liability. Well, no. IAS 23 has specific conditions. Okay, and we're going to understand what the actual accounting treatments are for these interest costs, which are also called borrowing costs. So like interest is like the rent on money, basically. That's the way to think about interest. It's the cost for using money. So we have to understand, what does IAS 23 actually say? Well, it says for a qualifying asset, i.e. one that takes a substantial time to complete, and where a loan has been used to produce or construct or acquire the asset, for the interest accumulating on that relevant loan, we capitalize it until the date the qualifying asset is ready for use, i.e. the Olympic Stadium is ready for use. That it can be used for watching games. Okay, that basically means when we say capitalize, we mean that we include the interest charge in PPE instead of recording it as an expense. So it becomes an asset instead of an expense, right? What is this? Okay, what is the double entry? So if it means for the interest charge, we debit PPE and we credit liability account. And when the asset is finally ready for use, we then depreciate the asset over its useful life, and we expense the interest. For the interest charge incurred after the date that the asset is ready for use, we then expense it to profit and loss. So it then hits finance costs. Okay. I just want to point out as well, we don't depreciate the asset from when it's actually used, we depreciate it from when it's ready to use. Okay, so be aware of the distinction. Now let's consider the exam situation that can arise, and these are broken down into two categories. So the first category arises where no accounting has been done. So they'll say in the exam question, we haven't accounted for the interest charge on the loan yet, but we know that the asset is a qualifying asset. What do we do? And you say, well, we need to debit PPE, credit liability, and we need to capitalize the interest cost on the loan until the asset is ready for use. Okay, that has to be done under IFRS. There's no option to expense it to P&L. The second situation that will arise is where the accountant has done what they think is right, but has done the wrong thing. Okay, so we have to consider what adjustment we need to correct for this. Okay, so for example, what you might see is that they posted the whole of the interest charge to P&L, so it's gone to finance costs instead of PPE. So the profit seems a bit lower than expected. But then you say you're wrong, you should have capitalized the interest charge until the asset was ready for use. So for the relevant interest amount, we need to reallocate it from finance costs to PPE. And how do we do that? Well, we debit PPE and credit finance costs. And the knock-on effect from that is that if your PPE carrying amount is higher, you're going to have potentially, if the asset is ready for use, you're going to then have higher depreciation. Okay, so you'll have to deal with the maths for that in the exam questions. Okay, so next we're going to move on to held for sale assets. Held for sale assets often these occur in the situation where you plan to recover the carrying amount of an asset by selling it instead of using it. Okay, so you don't use it over, you plan to stop using it over its useful life, you plan to instead sell it. And it's held for sale asset is just basically another category in the balance sheet. It's within non-current assets. It's just a separate disclosure. But it's quite, the criteria for recording a held for sale asset are very strict, as we're going to see now. So let's do a role play to fully understand what a held for sale asset is. So your CEO is in a contemplative mood. He says, I plan to sell a helicopter of 10k carrying amount next year. Will this amount still sit in PPE at the end of the year, and do I have to keep depreciating it? And then you say, because you're the accountant, Well, that depends on three criteria. We need to see if the asset is a held for sale asset. IFRS 5 is the way forward. Okay, so the question was, does the amount still need to sit in PPE if we're planning to sell it? And do we have to keep depreciating it? And you're saying, well, it depends. But then the CEO asks, what are the criteria for recording a held for sale asset? And I thought you were great in Batman, by the way. Well, you then say the first criteria is that the asset has to be available for use in its present condition. And available for use means that you can do some work to get it ready for use. So, for example, maybe cleaning it or vacating it. But it has to be. You have to consider what's normal for setting a helicopter. What sort of work has been done. If you're adding enhancements to the helicopter or painting it, that would mean that the asset is not available for use in its present condition. The second criteria is whether the sale is highly probable. And normally for held for sale assets, we expect to sell them within 12 months of the date that they become held for sale. Okay, and highly probable actually has has 5 criteria associated with it, which we're going to explore in the next slide. And the third criteria is that the asset must not be abandoned after the year end. If we don't have abandoned the asset after the year end, then it shouldn't have been a held for sale asset in the first place. Okay, so we have to consider what's happening after the year end as well, in order to determine if the classification is correct. And if you're an auditor, you'd probably look at what's happened after the year end. So for a sale to be highly probable, there are lots of 5 criteria attached to it, which you can make a note of in your open book. So the first one is that we have to have an appropriate level of management committed to sell the asset. So there has to be some commitment. There has to be an active program to locate the buyer, and the plan must have been initiated. The asset has to be actively marketed at a sale close to the fair value. Okay, I've said the fourth one, I've explained that one in a bit more detail, and there are no indications that the plan is going to be withdrawn or changed. Okay, so tab up this in your open book and then apply it to the question. See if these criteria are met. If not, then you can't have a held for sale asset. Right, now suppose the held for sale criteria is met. What difference does that make? Well, the held for sale asset, Ben Affleck says, is shown as a separate line in the non-current assets. It's not within PPE. And we say that from the point an asset becomes held for sale, i.e. meets the 3 criteria, we stop depreciating the asset. Okay, because we're not using it over its useful life anymore. Depreciation is not relevant anymore. Okay, so I'm going to explain these in more detail using a diagram. And also the third thing that I need to know is that the asset, we record the asset at the lower of its carrying amount and the recoverable amount, which is the fair value less cost to sell. Okay, so let's consider this helicopter. It has a carrying amount of 150k at 1st of January 2022, and our year end is 1st of December 22. What happens? Well, at 1st of July 22, the carrying amount is 100k and we've incurred depreciation of 50k. Right, so that depreciation hits our P&L as normal. But then we find that 3 criteria for the held for sale are met at 1st of July 22 somehow. That means that some changes need to happen. So the first change, which you can get a mark easily for saying, is that we need to stop depreciating the asset from 1st of July 22 onwards and look at assess the recoverable amount. The recoverable amount is equal to your fair value minus your cost to sell. And if I told you that in this case it's 70k, then we have a problem because the recoverable amount is less than the carrying amount. So we record the asset, held for sale asset, at 70k within non-current assets, within NCA, and then record an impairment loss of the 100k minus the 70k, which gives us 30k. and that reduces our profits, so the CEO isn't happy. Okay, so just maybe use this diagram to help you in the exam, and you probably have to do a bit of maths. So you probably have to work out the carrying amount of the 1st of July 22, assuming that, and you probably know the initial carrying amount. Okay, so just apply the maths, follow the workings, and then try and write as much as possible, and try and get as many marks as you can. So discontinued operations are linked to held for sale assets, and I'm just going to put an arrow and show you that if an asset is held, if a subsidiary or an asset is held for sale, then that means that could be an indication of a discontinued operation. Okay, so the two are interlinked. Now consider this example. Your CEO says, I want to sell the India branch of the business. It's not doing well. How is that going to impact our accounting and reporting? And you say, well, that depends if the operation is a discontinued operation. The CEO says, what is a discontinued operation? Why do you keep making up terms? I thought actors didn't have imagination. Well, he says, I don't have imagination. I'm an accountant. He says, a discontinued operation is a component of an entity that has been disposed of during the year or is held for sale. Okay, so there are two. It's either been disposed of during the year, so we've already sold it, or there's an active plan to sell it. Okay, so we've assessed those three criteria I've discussed before. And the CEO is a bit surprised. He thought there would be more stuff to say. And you say, well, another criterion needs to be met. Apart from being either held for sale or already disposed of, we have to assess, is it a major line of business? Or is a subsidiary acquired? Is it a subsidiary acquired for resale? So have we deliberately acquired it just to sell it on? Or is it part of a single coordinated plan to dispose of a separate major line of business or geographic operations? Okay, so there are three options, and we have to see if one of them has been met as well. So I've got a summary of the full definition to reiterate the key points. So discontinued operation is either an operation that's been disposed of during the year or is classified as held for sale. So that's criteria number one. And then we have criteria number two, where we have three options. Okay, we have to go through these three options and see if they've been met. So separate major line of business, so it has to be separable. Okay, so I think the India branch would meet this definition. Second one, we've already explained. It's a bit of a mouthful. This is part of a plan to dispose of a separate major line of business. Okay, so this one occurs a bit more often. Is a subsidiary acquired exclusively with a view to resale? Okay, so this is a very specific case, and it may or may not occur in the exam. I think the one I've ticked is the one that often occurs in the exam. Now, we have to understand what is the accounting impact for a discontinued operation. So let's see. Ben Afflex is going to explain to us. He's such a good guy. So he says as correct, we have to dispose the profit from discontinued operation in a separate line. Okay, in the P&L statement. Okay, so there's a separate line showing the profit from discontinued operations. And the separate line we show is the profit figure we calculate has two components. The first one is the trading profits until the date of disposal of the operation, and so that's point one. The second profit we have is the profit arising from the disposal of the operation. Okay, so when you're disposing of the operation, you might make a profit on it because the selling price is more than the fair value of it. So that profit gets booked to profit from discontinued operation. Okay, so here's the basic format of the statement. So you have continuing operations initially, and then you have discontinued operations. And discontinued operations are shown net of tax, but in the exam question they won't bring up tax. They won't, but just remember it's a separate line. But as you can imagine, that's not really telling us much, and the users will want to know more. So the user would want to have a further breakdown of this figure. They'll want to know the revenue in the notes or the face of the financial statements. They'll want to know the revenue, expenses, etc. that came to this profit figure. They want to have a full breakdown of this. And I've just got a snapshot of the standard that tells you the things you need to disclose. As we said, the profit from discontinued operations given by two components added together. So the profit from trading and the gain from selling it. And we can further analyze it, as I said, by looking at the revenue, expenses, and pre-tax profit, and the gain. So we need to have a full breakdown of the figure, basically. So maybe tab up your open book so that you know where to find it, or just be able to find it during the exam. And I think we'll stop there. Those are the key points I wanted to highlight. So as I said before, FER is about knowing the recognition criteria for certain things, and it's being able to apply them in an exam situation. It's not about regurgitating the standard, it's about picking out the clues in the question and saying this is true, this is not. Okay, so thanks everybody, and hope that was useful. Cheers, bye.